Welcome back. You're watching Stock Watch with me, Zinati Goma, and joining me to take your stock-related questions tonight are Willem Oldewage from Nitrogen Fund Managers and Shane Watkins from All Weather Capital. Be sure to send your questions on email at stockwatch@bdtv.co.za or via SMS on 41392 or on X using the hashtag Stockwatch. Thank you so much for your time, gents. It's been quite an interesting day. I guess seeming that markets are kind of undecided about where to go. We did have the Fed coming out with the interest rate decision and the tone, but also a lot of company news. I don't know, Willem, do you feel the same, that markets are just in a state of not knowing where to go at this point, what to follow?
Yes, I think it depends very much on which market you're looking at. I think the rhetoric from the US has all been sort of Fed-based, inflation-based, and generally it seems that we've priced in a full 1%, a 100% chance of a 25 basis point cut in the September Fed meeting, which has sort of driven a lot of the sort of upside in that market, just the discount rate coming down. And then we're looking at Europe. It seems from today's results that the consumer there is under a lot more pressure. Both VW and BMW reported, and those numbers were fairly weak. So SocGen reported that their retail division wasn't doing well, and then Barclays numbers were also not good. So I think those two markets sort of are at odds. And then the JC is mainly linked to China, which has got its own problems. The sort of manufacturing and sort of general consumer data from there has been very weak for a long time now, and the trend hasn't really changed based on the numbers there this morning. So the JC sort of coming off a little bit from yesterday, which I think is reasonable. We had a very strong close to August. And then, like I said, Europe seems soft, the US seems driven by rates.
Well, I mean, also part of the US sentiment there is the tech earnings, and actually it's quite a different tone that we're seeing this week compared to what we saw last week. We saw disappointments coming from Alphabet last week, but now seeming that Meta and AMD have boosted sentiment. Shane, is this investors coming back to that tech sector?
Zanati, I'll say what I said last time on the show, which is that interest rates are to financial assets what gravity is to physics. And we are, especially for long-dated assets, interest rates have a greater effect, what we call long-duration assets. So, we saw about an hour ago, the Bank of England became the first of the G7 countries to cut rates. Last night, the Fed said no cut now, but likely the next meeting there will be a cut. I think the SARB will probably follow the Fed quite shortly thereafter. And, obviously that is good for financial assets because it lowers the discount rate, and it's good for companies that are either geared to consumer spending or have a high level of debt. The Nasdaq's up 15% this year, and those tend to be long duration assets. So I think, you're right. I mean, we kind of are in a waiting pattern to see when both the Federal Reserve and the SARB cut rates.
All right. Well, gents, let us get to the questions. There's a question here on Capitec. Capitec is at historic highs. Is it a good time to short or buy the share? Should you ever short Capitec, Willem?
I think that's a very good way to start the conversation. I don't think there's been a chance in its sort of history to make money from a shorting Capitec. So in terms of their management team and their growth and the vectors they're pulling, it is a very impressive company, and they get their rating because they are growing at the pace they're growing. They did really well in retail sort of banking. Then they moved into sort of retail lending. They're now into business banking. And there are other options for them as well. I mean, they're doing airtime. They're very good at identifying gaps in the market and providing a service to a customer that wasn't serviced. And it doesn't seem that the competition, even though there are a few players, are really taking anything from them. I think they do really well, and I'd be hard pressed to go against that.
Yeah. I mean, there was a time when I guess investors were questioning because Capitec has had such astronomical growth in the earnings, but also in the share price, where there was a time that investors were asking themselves, where will the growth come from? Shane, is that still a question, or is it just, okay, we're seeing what they're doing and they're still going to continue to grow, and solidly at that?
Zanati, Capitec market cap is, I think it's about 250 billion, which would make it worth more than ABSA and Nedbank combined. Eventually, the growth has to slow because eventually, you are the sector. But I think in the meantime, they are delivering sort of a mid-20s ROE. Having said that, I mean, the price to book is 6 or 7 times, so it's expensive. But you have to say it's an extremely good company on a very high rating. The question was whether you should short Capitec. I've got to say, a little bit tongue-in-cheek, that I don't know a single person living that's made money shorting Capitec. So if you do make money this time, it will probably be the first time. I think it's generally not the greatest strategy to short companies that are good businesses.
All right. So both of you are agreeing that nobody's really ever made money from shorting Capitec. But if you are not in, of course, there's lots of regret from people that why didn't I enter 10 years ago? Why didn't I enter 5 years ago, even 3 years ago? If you are not in, would you still be buying? Because you mentioned, Shane, the high rating. I'll start off with you. If you're not in, should you still go in now? It is a good company. Still more growth, obviously, but you spoke about the growth slowing down. Would you be engaging in buying at this point?
So, you're paying a lot for the potential future. If you had to compare, say, maybe the best bank and the worst bank, let's say the worst bank is ABSA Banking Group. That featured rather prominently in the news over last weekend. That bank has a book value of about 170 Rand and is trading at 158. That means if we liquidated the business, we'd get back 12 Rand more than the current share price. Okay. Capitec is trading on 6 or 7 times book. So let's say the book value is 400 Rand. If we liquidate Capitec today, you're going to get 400 Rand. So you're paying the other 2,200 Rand or whatever for future potential in the business. But I mean, having said that, up until now, they've delivered, almost without fail.
Okay. That's quite an interesting analysis. Willem, on your side, buy at this point, obviously, Shane talks about the expected growth in the future, but also really what you'd be paying if the company got liquidated now. If you're not in, is this not a good time to be buying? And do you hope for one of those short-lived dips?
This sounds like any answer to any SA equity question in the last month. But given the sort of change in South African politics, along with the sort of expected future interest rate environment, I don't think there are too many bad options. Like Shane mentions, there are much cheaper entry points, but generally companies trade at ratings for reasons. I think ABSA, like Shane mentions, they're below their book value, but if you look why, there's very good reasons for the market sort of valuation of that company, and the same counts for Capitec. In terms of growth, obviously they can expand into different markets, they can expand into different sectors. As long as you believe in the company's sort of ability to execute, of which they have a very good track record, long term, I definitely would say it's a good buy.
All right. Well, let's go on to Richemont, another counter that is above most of what a lot of us can afford. Richemont, we're talking about the share and also the products. There's a comment here about the incredible compound returns on an investment in Richemont. Shane, just looking at, what Richemont has been able to churn out historically, would that be a good reason to go into the stock, even though the luxury market is experiencing a little bit of a wobble?
So Zanati, Richemont is in what I would call real luxury. So you get, I suppose, 2 categories of luxury. You get aspirational luxury, and that would be sort of a Michael Kors business. And then you get Hermès or Richemont or LVMH that are real luxury. They're actually selling extremely expensive, very high margin product, mainly to wealthy people. And that real luxury market has tended to be very much more resilient than the aspirational luxury market. I think Richemont is a very well-managed company. It's got some very good brands. I think it's excellent business. The main problem is the slowing sales in China. Luxury sales in China are down anywhere between 10 and 30%. I think Richemont has got to be let's say, a key foundation part of any portfolio, but there could well be further downside because of the slowing demand in China in the short run.
But would that downside present an opportunity, Willem?
Yes, I agree completely in terms of segmenting the luxury market. I think even within sort of the LVMH, Hermes, Richemont basket, the results have differed, where sort of Hermes has looked a little bit better, and that's even more high-end. So in terms of defensiveness, I think the further up you go, sort of up the food chain, the more defensive the companies become. And Richemont sort of somewhere in the middle with a lot of exposure, like Shane mentioned, to Asia and China. And China is not looking good. I mean, I'm not like trying to like be a monger or anything, but in terms of any numbers from China, none of it is looking good. Like there's always stimulus, the growth is not at the numbers sort of that's been forecast. And Richemont does have a large exposure to that. In terms of the business, again, I agree. It's a very well-run business with very good brands, and they'll definitely be able to diversify into other markets, into other sort of segments. I'm sure they can weather sort of a Chinese sort of downturn. But in terms of the share price, I think that the reaction could be fairly negative if results don't improve in the next set of results, if the performance doesn't improve in the next set of results.
Yeah, nothing like the luxury sector to show you that there are levels to this. There's actually, been very interesting questions around the consumer stocks on the JSE, and particularly because of the optimism that we saw after the GNU announcement. Are they still on solid ground, considering the fact that there are also expectations of interest rates that are due to come through, or have we seen a little bit of a simmering down there? Shane, I want to start off with you.
So, Zanati, we've had, I guess, 15 years of almost no growth in our economy. GDP growth 1% or less. Yesterday, the Office of the Presidency did a presentation showing that within 3 years, we could potentially get economic growth to 3.5% per annum. Wow. Now, it's been almost 20 years since we've had 3.5% per annum GDP growth. And this is, I think, a rather credible plan that they presented. I mean, it's essentially fixing Transnet, fixing Portnet, fixing the rail network, fixing Eskom. These big parastatals are really enablers for the private sector. I mean, over 50 billion of lost exports didn't happen last year because the Transnet rail network was down and we couldn't export coal and iron. If you couple fixing our state-owned entities with lower interest rates and more sensible growth-oriented policies, I think there's a lot of space for the consumer and investment to do significantly better. And I think, to be dead honest, I think a lot of our consumer shares still look cheap.
Well, quite interesting because, for example, when you look at Woolworths, not really too much of a question of South Africa. Obviously, their health and beauty segment in South Africa is still wobbly because of the consumer, but food division is doing well. But really a lot of the pressure coming from Australia and New Zealand. What do you do with a counter like Woolworths, Willem?
Well, I want to say that I think you can't value a company based on 6 months' earnings or on 12 months' earnings, and they've had a bad 6 months, let's be dead honest. I mean, I think they said earnings are going to be down 30%. A very good food business and I think potentially a good health and beauty business. I know that there have been some management changes recently to address the issues in health and beauty, and I think Woolies is probably still a buy, my opinion.
Okay. Shane's still quite optimistic about Woolies. Willem, that mixed picture, but really seeming that a lot of the pressure coming from the Australia and New Zealand business on that front. Yeah, what do you make of the Woolies trajectory so far, and also just what they need to do in order to kind of get that business on a uniform positive trajectory?
Yeah, so I think in terms of valuing Woolworths, the simplest and sort of the most accurate method would be to do a sum of the parts valuation using sort of multiples towards earnings or EBITDA from each division. So Woolworths Fashion, Beauty and Home, Woolworths Food, David Jones, and the financial services. And if you do that, especially given the latest sort of share price action, it's been lagging. So in terms of the last 6 months results being a bit of a mess, I think it's about R3.70 and the expectation was R4. I think the market has seen that coming. So that's fairly positive in terms of the entry price right now. In terms of the business, I think food's good. I think that you keep doing what you're doing. And in terms of David Jones, something needs to change. I think you can maybe look at what other Australian players are doing, or sort of, like how they're performing. And then in terms of fashion, home and beauty, that's also, I mean, it's not a terrible business. It's sort of in line with sort of it's a decent business with a decent rating, and there is some sort of real margin and real growth. So in terms of holding the stock, I think it is a good stock to buy in the consumer front. It's lagged by a long way against both food and clothing in South Africa.
Yeah.
If you were to look at something like Truworths or Pushini's or Shoprite, or even recently Pick n Pay, Woolworths has been the laggard, I guess, to some degree, deservedly, based on the latest results. But going forward, I also agree with Shane that 6 months aren't the whole result, and they have performed better. And I think we're maybe at the bottom of the sort of analyst and investor sort of pessimism in terms of their ability to execute. So yes, I agree that this is not a bad entry point for Woolworths.
All right. Talking about consumer, let's talk about the consumer that drinks beer. That's AB InBev. They came out with results today, surprising to the upside in terms of what they produced on their core profit. Shane, would this be an attractive buy?
So AB InBev is obviously a hugely diversified global business. It incorporates the old SAB Miller. Beer has been a declining volume business in the United States and in most of kind of the developed market. And the growth has been in emerging markets, which is why SAB Miller targeted emerging markets in the first place. But I think that, this would be a slow and steady opportunity. You're not going to get great excitement out of it from here. But there has been a recovery in beer volumes, not in South Africa, but just globally.
I was trying to look for a Warren Buffett quote that said that I think good returns are the ones that attract yawns. Something like that. I'm just paraphrasing right now, but could this be one of them, Willem?
I share Shane's sort of, I guess, unexcited opinion about beer businesses. I saw Heineken also reported, and they actually had a very sort of negative result. They missed by a long way, and the share was down 10%. And in the long term, we're sort of modernizing. People are stopping smoking. It's no longer like cool to sit on your deck chair with a cigarette and a beer in your hand. Mm-hmm. So in terms of sort of the longer term sort of outlook, it's fairly unhealthy. The regulation around it's not too sort of aggressive, but I think in terms of sellability or sort of marketability, it has changed, and I think the results they exist, but in terms of sort of seeing massive growth, I agree. I don't think it's too exciting in the long term.
If you believe the South Africa story, which we do, then you're going to have lower interest rates and probably a stronger rand. And one of the things that's governed investors to a large degree over the last probably 10 years has been the expectation of a weaker rand. But in a better scenario, we could have a stronger rand now. And then you wouldn't necessarily want to be in British American Tobacco or Anheuser-Busch or Richmond for that matter, because the currency could strengthen by 10% and you will immediately lose that on these offshore earners.
All right. Well, here's the quote I found. Beware the investment activity that produces applause. The great moves are usually greeted by yawns. But I guess NVIDIA investors would strongly disagree there. Gents, let's go on to Mondi. They also came out with results today and actually declaring a special dividend, even though we did see the profits slumping there. Yeah, Shane, what would you say in terms of Mondi, their performance, but also just operating in the kind of cyclical environment?
So Mondi's an interesting business. It was unbundled out of Anglo-American, I guess, about 15 years ago. They paid a special dividend partially because they sold their Russian business, and they will need to replace those earnings in some way going forward. So, we thought the margins were a little bit lower than expected. I think, if I'm dead honest, I think from here I'd say unexciting, and particularly so if the rand continues to strengthen.
Well, actually, I mean, just looking at the performance, the share price was up a little. Was that Willem just being buoyed by that special dividend, not necessarily the numbers that came out?
Yeah, I think I agree on the margins. The Russian business was a very good business for Mondi. Unfortunately, in a country run by sort of a very specific sort of character and sort of warmongering, so they had no choice. But that means the rest of the business has always sort of got a little bit of like uplift that you saw in the group margin. So the remaining business, it always looks like a premium business in terms of like performance margins and the operational sort of quality, which now sort of doesn't seem the same way. So in terms of forward growth, I think it is very much a wait and see. I can't see it sort of being an exciting. I don't see any near-term catalysts in terms of them sort of unlocking anything. There was a flurry with the DS Smith potential offer. I don't know if you recall at the beginning of the year of interesting activity. So I think there is sort of incentive and there are options being looked at, but until they materialize, I agree. I don't see a sort of short-term unlock of value in the Mondi share price.
Okay. What about ArcelorMittal? Because it was punished by the markets today, some more pain on there. And it did widen its headline loss, but saying that they actually are hoping or looking at a profitable second half. Shane, do you see this materializing?
So there's an interesting business in the sense that the market cap is 1.5 billion and the revenue is probably 50 billion. The business employs directly and indirectly 80,000 people. And so it's become a very, very small company market cap wise, but it has quite a broad impact on society. And, as I said, from a revenue perspective, it's a big business. I think they've got a huge amount of debt, I think about 4 billion on a market cap of 1.5 billion. So lower interest rates will help them. There's a 9% tariff just been introduced on hot rolled coil and flat plate. They've been competing with cheap Chinese imports. That'll help them a lot. And then I think if we see sort of an infrastructure story in South Africa, like the government has been talking about, I think it's likely that the business, it's a highly speculative story. I mean, you're really swinging for the fences.
Would you also see it as speculative, or do you maybe see some green shoots that could come through for ArcelorMittal, or is it just too shaky at the moment, Willem?
I mean, they're an iron ore smelter based in South Africa, and I think for a large part, you have to look at sort of the input costs, which is iron ore, which has done way worse than sort of, although the average level has been way lower than the last sort of 2 or 3 years for the last month or two. But in terms of that coming through and sort of being a definite for the next stop is pure speculation. And in terms of sort of cheap Chinese iron ore, remember, they're also going to get the cheap iron ore and the cheap coal, and they're also going to be able to produce their sort of rebar and coils and all those products at lower prices. And the economy is struggling, so I think they're incentivized to sort of, produce. So in terms of ArcelorMittal, I mean, it's speculative. I personally would not be sort of interested in it. We've looked at it once or twice in the past and sort of always turned around and walked away.
Yeah, all right. I hear you on that. Well, gents, let us get to attractive picks for you today. Your stock picks. Shane, what are you choosing?
Zanati, I'm going for Remgro. Remgro is a highly diversified company. They have a healthcare business, Mediclinic. They have some financial assets such as Outsurance, which is extremely good business. They have a fiber business. They have some industrial businesses, and it trades at a 47% discount to NAV. And as I said, it's in some ways like a unit trust on the JSE, and I think you can buy this one at a discount. It's got unexciting management, but it's sufficiently cheap.
All right. What is exciting you, Willem, today?
My stock pick is going to be Kumba Iron Ore. I think if you look at Kumba against a Rand iron ore price, specifically take into account that they produce 64%, not a 62% quality on their resource, and they have a very high lump to fines ratio, you should be getting a much better sort of rating in terms of the Kumba share price against iron ore. That coupled with the fact that a large part of their sort of the sort of weak earnings over the last, it's only the last half, are due to sales volumes, which is driven by Transnet. Now we're hearing the government are working on Transnet, they're working on ports. Kumba's producing 36 million tonnes where they used to produce 44 million tonnes. It's not a short-term story, but in the medium to long term, if those efficiencies can come back, that's pure margin. They need to get a few trucks up and running, and then they need to get those iron ore fines to the port and out to China. Along with that, you can look at the sort of projects they got in the pipeline. As soon as things do go better, they can do a UHDMS, which is an ultra-high density media separation unit, which would improve their sort of life of mine. They're incredibly lean and mean. I mean, they just do iron ore. They've only got the employees they need. They've got this project saving costs, 3 billion rand for the year. So in terms of management and sort of potential sort of gearing towards any uptick in either China or Transnet or the iron ore price, I think Kumba's a very good play, and the current price reflects sort of a very good entry point towards any of those catalysts.
All right. Well, thank you so much for your time and for your analysis today, gents. Much appreciated. That is all for tonight's Stockwatch. Thanks to our guests, Willem Oldewage from Nitrogen Fund Managers and Shane Watkins from All Weather Capital. Up next, The Close. Stay tuned.
Thank you.